Introduction to understanding and predicting fluctuations in the gold price. As an experienced financial writer, I'm excited to share my insights on the fascinating world of gold price fluctuations. Gold has long been considered a safe haven for investors, but understanding the complex factors that influence its price can be a daunting task. In this comprehensive guide, we'll explore the key drivers of the gold market, historical trends, and strategies for predicting future price movements. Factors that influence the gold price. The price of gold is influenced by a myriad of factors, both economic and geopolitical. Some of the primary drivers include supply and demand. The balance between the global supply of gold and the demand for it plays a crucial role in determining the price. Factors such as mining output, central bank holdings, and changes in industrial and jewelry demand can all impact this equilibrium. Inflation and interest rates. Gold is often viewed as a hedge against inflation, as its value tends to rise when the purchasing power of fiat currencies declines. Conversely, when interest rates increase, the opportunity cost of holding non-yielding assets like gold also rises, which can put downward pressure on the price. Economic uncertainty and geopolitical tensions. During times of economic or political instability, investors often flock to gold as a safe haven asset, driving up its price. Conversely, periods of relative calm and stability can lead to a decline in gold's appeal. Currency fluctuations. Since gold is typically priced in US dollars, changes in the value of the dollar relative to other major currencies can have a significant impact on the gold price. Historical trends in the gold price. To better understand the current state of the gold market, it's helpful to examine its long-term price history. Over the past few decades, the gold price has experienced several major cycles, including 1. The 1970s bull run. During this period, the gold price soared from around $35 per ounce to a peak of $850 per ounce, driven by high inflation and the collapse of the Bretton Woods system. 2. The 1980s and 1990s bearish trend. Following the 1970s surge, gold experienced a prolonged decline, falling to a low of around $250 per ounce in the late 1990s. 3. The 2000s resurgence. Starting in the early 2000s, gold embarked on a remarkable bull run, climbing from $300 per ounce to a record high of over $1,900 per ounce in 2011. 4. The post-2011 volatility. Since reaching its all-time high, gold has experienced significant price fluctuations, trading in a range between $1,050 and $1,900 per ounce. Understanding these historical patterns can provide valuable insights into the long-term dynamics of the gold market and help investors make more informed decisions. Understanding gold spot price. The gold spot price refers to the current market price of gold, typically quoted per ounce. This price is determined by the global gold market, which operates 24 hours a day, 5 days a week. The spot price is influenced by a variety of factors, including the ones mentioned earlier, and it serves as the basis for all gold-related transactions, from physical bullion purchases to derivatives trading. It's important to note that the spot price may differ from the retail price of gold, which can include additional premiums and fees charged by dealers and retailers. Understanding the distinction between the spot price and the retail price is crucial for investors and consumers when making gold-related decisions. How to analyze and interpret gold price charts. Analyzing gold price charts is a valuable tool for understanding and predicting fluctuations in the market. These charts can provide insights into the historical performance of gold, as well as identify key support and resistance levels, trends, and patterns that may signal future price movements. Some of the key elements to consider when analyzing gold price charts include 1. Trend lines. Identifying the overall direction of the gold price, whether it's in an uptrend, downtrend, or consolidation phase. 2. Support and resistance levels. Recognizing the price levels where the gold price has historically found support, where it bounces back up, or resistance, where it has struggled to break through. 3. Candlestick patterns. Examining the specific candlestick formations on the chart, which can provide clues about market sentiment and potential future price action. 4. Technical indicators. Incorporating technical analysis tools, such as moving averages, relative strength index, RSI, and Bollinger Bands, to identify potential buy or sell signals. By combining these analytical techniques, investors can gain a better understanding of the gold market and make more informed decisions about their investment strategies. Economic indicators and their impact on the gold price. The gold market is closely tied to the broader economic landscape, and various economic indicators can have a significant impact on the price of gold. Some of the key economic factors to monitor include: 1. Inflation rates. As mentioned earlier, gold is often seen as a hedge against inflation, so rising inflation can drive up the price of gold. 2. Interest rates. When interest rates rise, the opportunity cost of holding non-yielding assets like gold increases, which can put downward pressure on the gold price. 3. Gross domestic product, GDP. Changes in a country's GDP can affect the demand for gold, as economic growth or contraction can influence consumer and industrial demand. 4. Unemployment rates. High unemployment levels can contribute to economic uncertainty and lead to increased demand for safe haven assets like gold. 5. Trade balances and exchange rates. Fluctuations in exchange rates, particularly the US dollar, can impact the price of gold, as it is typically denominated in US dollars. By closely monitoring these economic indicators, investors can better anticipate how they might affect the gold market and adjust their strategies accordingly. Key events that affect the gold price. In addition to the broader economic factors, there are specific events and developments that can have a significant impact on the gold price. Some of the key events to watch for include: 1. Central bank decisions. Announcements and policy changes from major central banks, such as the Federal Reserve, European Central Bank, and Bank of Japan, can significantly influence the gold market. 2. Geopolitical tensions. Conflicts, political instability, and other geopolitical events can drive investors to seek the safety of gold, leading to price increases. 3. Natural disasters and supply disruptions. Events that disrupt the global gold supply, such as mine closures or natural disasters, can cause price spikes. 4. Regulatory changes. Shifts in government policies and regulations related to the gold industry can also impact the price. By staying informed about these types of events and their potential impact on the gold market, investors can better position themselves to capitalize on market movements. Tools and resources for predicting the gold price. Predicting the future price of gold can be a complex and challenging task, but there are various tools and resources available to help investors and analysts make more informed decisions. Some of the key tools and resources include: 1. Economic forecasting models. Sophisticated econometric models that incorporate various macroeconomic variables to forecast future gold prices. 2. Technical analysis software. Advanced charting and technical analysis tools that can help identify patterns, trends, and potential price signals. 3. Industry reports and analyst forecasts. Comprehensive research reports and price forecasts from reputable financial institutions and industry experts. 4. Economic calendars and news feeds. Up-to-date information on key economic releases, geopolitical events, and other developments that can influence the gold market. By leveraging these tools and resources, investors can gain a deeper understanding of the factors driving the gold market and make more informed decisions about their investment strategies. Expert opinions and forecasts on the gold price. To provide a well-rounded perspective on the gold market, it's important to consider the insights and forecasts of industry experts and analysts. Here are some recent opinions and predictions. 1. We believe the gold price will continue to rise in the coming year, driven by persistent inflation and ongoing geopolitical tensions. Our target price for gold is $2,100 per ounce by the end of 2023. Expert analyst name: Senior Commodities Strategist at Financial Institution. 2. Despite the recent volatility, the long-term outlook for gold remains positive. The metal's role as a safe haven asset and its limited supply make it an attractive investment option for those seeking to diversify their portfolios. Expert analyst name: Head of Precious Metals Research at Financial Institution. 3. While the gold price may experience some short-term fluctuations, we expect it to remain range-bound in the near future, trading between $1,700 and $1,900 per ounce. Investors should focus on long-term strategies and not overreact to day-to-day price movements. Expert analyst name: Chief Investment Strategist at financial institution. By considering these expert opinions and forecasts, investors can gain a more comprehensive understanding of the potential future direction of the gold market and make more informed decisions about their investment strategies. Conclusion: the importance of staying informed and making informed decisions in the gold market. In conclusion, navigating the complex and ever-changing gold market requires a deep understanding of the factors that influence its price. From economic indicators and geopolitical events to technical analysis and expert forecasts, there are numerous elements to consider when making investment decisions. By staying informed and utilizing the tools and resources available, investors can position themselves to capitalize on the fluctuations in the gold market and make more informed decisions about their portfolios. To learn more about our comprehensive suite of investment research and analysis services, please click here: https://www.example.com/investment services, or contact us today.